Hey guys, John from Gutenberg Research here. In this video, I want to take you through our equity risk premium model. And the reason I think this is a good time to do this is that the Fed met last week and they decided to keep interest rates flat. That's this one sentence here from the press release. In view of realized and expected labor market conditions and inflation, the committee decided to maintain the target range for the federal funds rate at 0.5% to 0.75%. So that one sentence could have changed your view on equity returns for the full year of 2017. And I want to show you how we incorporate that into our models and how we estimate the equity risk premium and how you can make your own estimate for the full year 2017. So I'm going to do that in this video now. The first thing I want to do is start with demonstrating why this is important. And I think I'm going to use our Apple model to do this. So I think a lot of investors sort of lose sight what's going on in share valuation when they apply a market-based price earnings ratio to forward earnings, because they sort of don't have any view on what exactly is going on from like a discounted cash flow standpoint. So that's why I'm using our Apple model, because for one, most of you are familiar with how it works, and two, we use a discounted cash flow valuation as well as a market-based multiple. So let's scroll down to the valuation section here. And you can see we've got a lot of metrics in here. But I just want to focus on this one, the constant Sharpe ratio, implied volatility, and risk premium. So we're throwing out a lot of key terms here. Don't get confused. This is actually a relatively simple approach to estimating share valuation. So all the equity risk premium is it's the required return that investors will have to be compensated for in excess of the risk-free return. So what that means is during periods of high volatility and uncertainty, investors will require a greater level of return, and during stable times, they'll require less return. So with that theory in mind, you can change the equity risk premium by changing volatility assumptions for the next year. So right now we've got implied volatility at 15.87%. So let's change that to 16%, and watch down here what happens to the share valuation as we do this. So I'm going to change this to, well, I'll change it to 17%. And you can see share valuation dropped from about 135 to 129 just with that one little change, and the equity risk premium jumped too. So before we were at about 4.9% equity risk premium. Now it goes to 5.2, and share value came down by $5 a share. So that's why equity risk premium is so important. What this is doing in here is it's calculating the required return specifically for Apple shares, and it uses the capital asset pricing model and Apple's beta, which is just a measure of how correlated Apple's share returns are with the S&P 500. And it uses those two measures to calculate the required return on Apple shares, and then it applies the equity risk premium to get to a required return for Apple overall. So you can see how important it is from a stock valuation standpoint. And even if you don't fully understand all of those inputs, you should just recognize the fact that as volatility increases, share valuation will come down. As interest rates increase, it has sort of a multiple impact. On the one hand, the discount rate overall goes up, and so share price would also come down. But at the same time, there's an offset if the excess return over the risk-free rate is greater. So it's going to also rely on your projections for 2017 market returns. So I know that's a lot to absorb in 4 minutes. So let me just walk you through exactly how this works. So let's close the Apple model, and let's go to our equity risk premium model. And you can see I always keep it at the top because it's a very important metric. It's going to have significant impact on your portfolio valuations over time. So it should really be in the forefront of your mind. And this model at the top is sort of what we would consider our consensus-based equity risk premium model, although there's not a reliable estimate for consensus on equity risk premium. But I'm going to actually go down to my estimates here, and I'm also going to show you how you can input your own estimates into this. You really only have to change 3 sets of cells, and you'll have your own forecast for equity risk premium for 2017. So while this is opening, let me just show you how this works. So there's 2 steps in calculating the equity risk premium using the constant Sharpe approach. Now, I like the constant Sharpe approach because it uses volatility and interest rates, so it's a great way to get those two metrics into your valuation. There's lots of different other ways of calculating equity risk premium, so you can use your favorite. So the first step in calculating the constant Sharpe is to calculate the constant Sharpe over time. So you can see what I have here is I have the actual total return for the S&P 500 going back to 1963, and I have the 10-year U.S. Treasury rate, so I'm using the 10-year as a proxy for the risk-free rate here. And then I calculate the excess return of the S&P 500 over the 10-year Treasury rate, and I do that for all the years back to 1963. Then I take the average excess return and divide that by the standard deviation in returns over the same period, and that gets us to our constant Sharpe ratio. So you can see that I've estimated it at just above 0.3, so it's about about 0.31. So then once you have the constant Sharpe, calculating the ERP is actually relatively easy. You just apply a measure of volatility. So in this case, since we're using the S&P 500, we use the VIX. And the VIX is the implied volatility on S&P 500 options, and it's quoted in percentage terms. So you can see, using the 12-month trailing average VIX, which I use to sort of stabilize things. If you use a daily VIX, then your valuations are going to change every day by a significant amount. So you have to decide what is appropriate for your models based on your time horizon. But I use the 12-month trailing VIX. So using 15.87%, that gets us to an equity risk premium of 4.9%. So that's what you saw in the Apple model. So in the Apple model, I took this number here and this number here for the equity risk estimate, and that's what we use to calculate our required return on equity for Apple. So you'll find this in all of our models that use a discounted cash flow valuation. and if you scroll down here, you can see through history. So I thought this would be an important chart. So this shows the equity risk premium back through 1994. And this line here represents the average. So the average equity risk premium is about 6% or so. And you can see that during times of severe uncertainty, there's spikes. So this is the credit crisis of 2008. You can see that the VIX popped up to 12%. So volatility was very high at that point. And it's stabilized over time. And so now we estimate that we're about just under 5%. So just under the long-term average here. So what next? So now I want to show you the sources of data that I use to estimate this. So you can see that I have the links right here. So you can actually go back and validate this data. I have the S&P 500 returns on this tab, interest rate assumptions on this tab, and then volatility assumptions on this tab. And this is where I get each of those items. So we're going to skip the interest rates for now. And we'll start with volatility. So for volatility, we use the St. Louis Fed data. So you can see that they have VIX estimates you can do on a daily basis, on a quarterly basis, on a weekly basis, whatever is appropriate for your investment horizon. And you can edit this chart. You can see that we've kind of entered this period of lower volatility. And this is actually against my original expectations. So if you have been following my equity risk premium, I was estimating that volatility would increase after the election, and it has not done that. So I have actually revised my VIX assumptions for 2017 down just a bit. And I'll show you where this goes into our model. So we go back here, back to the constant Sharpe. So if you want to project forward, you want to change your VIX assumptions, you would put that right here. So these 4 quarters, I think I was at 16% volatility for the first quarter. I brought it down to 13%. And I did that based on this chart. So that's the VIX. Next is the market return assumptions, which we get from the S&P 500. So you can change, if you want to look back at the last 10 years, you can do that. If you want to look year to date, that's what I had it set on prior to this meeting here. But again, all of the historic data is available here. So you don't have to go back through time. I've already done that. But you might want to use that for your market rate assumptions, which you would input here. So right now, in my model, I'm expecting the market to return about 12% for 2017. And then the final estimate is the interest rate assumptions, which you put here. So there's a little caveat here. So the interest rate assumptions are very important, and it's something that's somewhat difficult to project, but let me show you where this is coming, where my estimates are coming from. So first of all, you can kind of read what I did here. So I wrote, my estimates also assumes a 1.3% increase in the 10-year treasury rate, which reflects about 80 basis points of increase in the Fed funds rate, or approximately 3 25 basis point increases next year, and about 50 basis points of spread between the Fed funds rate and the 10-year treasury rate. So where did I get that estimate from? And you'll notice that the estimate of the Fed funds rate is pretty consistent probably with what you've been reading out in the market. So there's no rocket science here. Everyone has the same estimate because everybody is just mirroring what came out of the Fed's minutes. So if you go to the Federal Reserve's website and you click on the recent FOMC press conferences, you'll see this download here, projections material. So if you click this PDF, this shows what the Fed's current estimates are. So they have estimates for all of the major economic assumptions which they use in deciding whether or not to change interest rates. And then they have their Fed funds rate estimates here. So this is all of the Fed members put in their estimates, and this is what it comes out to be. So how did I get the 80 basis point change for 2017? I simply took the 1.4% estimate and I subtracted the current 0.6%, and that gets you 80 basis points. And so how do I decide that there's going to be 3 increases next year? I just divide 80 by 25 basis points. So I'm saying that if they continue to step up at a quarter percentage point at a time, then they will reach 75 basis points, which is close enough to 80. So that's how those estimates work. And you can see they actually have longer term estimates in here as well. So if you want, you can bring your equity risk premium estimates out to further along than just the end of 2017. So that gets me to the 80 basis points. And then I said there'd be an additional 50 basis points of steepening. So the Fed funds rate is really a short-term interest rate. And I'm using 10-year treasury rates in my model. So if the yield curve stays perfectly parallel, then there'd be no additional shift from a steepening. But I'm saying there's going to be a steepening in the yield curve of about 50 basis points. So I needed to add that additional 50 basis points in there. So you can see what I did is I just spread out for each quarter. I added 0.325%. So that gets me to my 80 basis points plus my 50 basis points of spread, just spread out evenly. So all you need to do if you want to come up with your own forecast for 2017 equity risk premium is change the S&P 500 total return expectations here in this cell, change the VIX assumptions in these 4 cells, and change the quarterly risk-free rate in these four cells. And at the end of doing those items, you'll have an equity risk premium here. So let's give it a shot. Let's say that you're bullish on the economy and you think market returns are going to be 15% next year. So change the 12% to 15%, and you can see that recalculated in this cell the new constant Sharpe ratio. And let's say that you think the volatility will stay somewhat stable. So you're going to replace my estimates with whatever you think is a fair estimate there. And maybe with the improvement in the economy, we'll see a faster increase in interest rates. So we'll add 50 basis points each quarter. Okay, so when you do that in that sort of Goldilocks scenario, you end up with an equity risk premium of just 4.5% at the end of 2017. So at that point, equities across the board will increase in value, and as will Apple, and that'll be a pretty good scenario for the economy. On the other hand, if you think things are going to be maybe not so good, maybe you've changed the S&P 500 total returns to just 6%, and maybe you think that volatility is going to spike here, 20. This is sort of a worst case scenario, maybe maybe not heading for a recession, but not doing all that well. And then maybe we just end up keeping interest rates flat. So you can see in that case, the equity risk premium went up to 5.5%. You can also stress the model if you think that we are going to head for another recession. So go back to volatility rates similar to what we saw during the downturn. And maybe there's like a sharp spike at the end. And you can see that you can really stress the equity risk premium and get it up to a pretty high rate. So this is 7.2%. So lots of options here. Download the model for yourself. Check it out, plug in some of the options, and if you would like, you can submit it here by filling out this form, and I will feature it here on the website for our other community members to download. Thanks for watching, and good luck with the rest of earnings season.